Hello and welcome back to my series on contemporary mathematics from OpenStax. In this video, I'm going to briefly talk about section 6.12, which is renting and homeownership. I'm going to only hit some highlights in this particular section because most of the math is the exact same formulas that you've used in the past sections. But let's go ahead and review the learning objectives for this section, and then I will jump to the actual examples that I want to look at for this video. So first thing we want to be able to do is evaluate advantages and disadvantages of renting versus homeownership. So those two objectives, looking at comparing and contrasting the benefits and the disadvantages of renting and homeownership. Calculate monthly payments for a mortgage and related interest costs. And that is actually done in the same way that we've done loans in the past. Read and interpret an amortization schedule, again something we've done in the past, and then solve application problems involving affordability of a mortgage. So I'm going to leave you to read most of this section, and I am going to jump down to something that's important to buying a home. And that is something called escrow. So I want you to read the rest of the section. Of course, there is lots of great information, but the one thing that may be relatively new, all the other information is pretty much the same. The payment formula is the same. The basic terminology as far as the principal amount, interest rate, term, all of those are the same. The only thing about a mortgage as far as terms is this unit this section mostly talks about fixed rates mortgages, which means that the APR is the same throughout the entire term, and it usually gives two types of terms, a 15-year term and a 30-year term. That's your two major types of mortgage terms, and there's benefits and drawbacks to both of those, of course. There's always kind of this give and tug when it comes to different aspects depending on where you are financially or even where the market is financially in terms of interest. So one thing that may be different, that if you've never bought a house or, maybe you've not bought a house recently, I don't know what your background is with regards to purchasing homes, but there is this aspect of mortgages that's different than other loans called escrow. And so an escrow account is a type of savings account that's maintained by the mortgage company or the bank that lend you the money for the mortgage. And the purpose of the escrow is to, out of that savings account, pay for the homeowner's insurance, if that's something that you are required to have in your state. And in the state of North Carolina, where I am from, that is absolutely required. You also have private mortgage insurance that you can actually get taken off under certain circumstances, and the book talks about that. But if you don't have all of that money up front, then your mortgage company can set up an escrow account and pay for those things out of the escrow account for you. And it's kind of nice. It allows for the mortgage company to handle the taxes on it. The mortgage payment comes from you to the mortgage company. But the taxes and private insurance and stuff like that. And so it's really helpful if you need to kind of plan that out. You don't have all that money as lump sums at one time. So that, that can kind of get a little involved. Sometimes escrow accounts can have fees associated with them, so you have to really look at your terms and your agreement that you make with your mortgage company, because it is a quote unquote savings account, but sometimes it can have a maintenance fee that the mortgage company is paying you because they have somebody there maintaining that money and ensuring that the money gets paid. But Let's actually look at an example of how escrow is paid out. So here in this example, we have Jenna decides to purchase a house with a mortgage of $108,000, $108,450. I'll get it right in a second. At 6% interest for 30 years. The assessed value of the home is $75,600. So she paid more than the assessed value, which most of the time you do, unless you're paying tax value. Her property taxes are 5.7% of the assessed value. So that's basically her taxes. And she has to pay homeowners insurance every 6 months, which is $744 every 6 months. So how much, including escrow, will she pay per month? So I'm going to highlight some important things here about what's going on. First of all, this is the principal amount. So I'm going to call it capital P. This 6% here is the R, and that's going to be our R. And we're going to have to use the TVM calculator because we're going to have to find out her payment. And then her 30 years, that's going to be the T. So T is 30. And what that's going to end up converting to as far as periods go, because she's paying it 12 times a year, every month, that's going to end up converting to 360 periods for this is to calculate her payment. All right. Now, for the escrow account, we take into consideration the assessed value. Let me get a different color when we talk about escrow here. So let's move over to this pink for the escrow. So this is the assessed value of the home. This is her property tax, essentially 5.7%. She also has to consider her insurance every 6 months. So when it comes to taxes, those are paid once a year. So let's calculate basically her taxes for the year. So taxes, if I come over here, we're going to look at the tax on the house. That's going to equal the assessed value, so the 75,600. All right, times the rate of her taxes. So that's going to be 0.057. All right, and so if we put that in the calculator, and I'm just going to do it on a calculator that I have here on my desk, times 0.057, that's going to give me, for the whole year, the taxes are going to be $4,309.20. Now, that's for the whole year. So to find how much it's going to be added to her monthly mortgage payment, we divide that by 12. So if we divide that by 12 to make it monthly, then we're looking at $359.10. So what that means is, instead of paying the $4,309.20 all at once to the government, really it would probably be her county taxes. She's going to end up paying, or her property taxes. She's just going to put back into an account, or rather, she's going to pay extra on her mortgage for her mortgage company to put back an extra $359.10, so that at the end of the year, when the next year comes around, she has that $4,309.20 in a savings account, in an escrow account, that they can pay that from. And then for the insurance, so for insurance, we're going to take the $744, and we're going to divide that by 6, because that's paid every 6 months. And we are going to do 744 divided by 6, which gives us $124. So we've got $359.10, $124. So So let's keep that in our mind. So $359.10, $124. That is going into the escrow account. But now we need to figure out how much her actual payment is. So we need to go over and get the TVM calculator. All right, so here we have the TVM calculator. We had 1,008, 450. Let me change that to $450. Now her interest rate was 6% on the home for 360 months because it was a 30-year loan. We can put 0 in the future value. And so it's going to be $650.21 is going to be her mortgage payment. And we're going to add to that the insurance and the property tax. And so let's look at that. And so what ends up happening is we got that $4309.20, and that we divided that by 12. So because that was each month, so we get that $359.10. And then the $744 for 6 months, so that's $124. And so if we add those, and there's a minor error here because, again, the books made a mistake. They're kind of full of those in this first edition of the book. They've switched this up. It should be $450, and they did $405. But we get really close to what it should be. So 3, 5, 9, and 10. And what our actual answer should be, which was $650.21. So if we added it up like it was supposed to be, $650.21 plus the $359.10 plus the $124. I mean, it's really close. It's just off by a few pennies, but you know, when you're talking about mortgage payments and homes, that really counts. So the total that Jenna is going to pay to the mortgage company is going to be $1,133.31 using the correct numbers. 31 cents, sorry. Because again, this should have been $450. So that should have been 400. I can't get it right either. That should have been 650. Give me 1 second, because I can't switch him back and forth using this software that I am using. But I can do a quick calculation to go backwards and get it to be 650.21. So this should be 650. Zoom out. I didn't mean to zoom in there. So that is going to be the total amount paid to the mortgage company, because this last little bit is going to go into an escrow account in order to help Jenna pay for her insurance, which is the $124 a month, and the property taxes, which is the $359.10. So this is something that mortgage companies can set up to kind of help you kind of plan for the future. The only issue with this is because taxes go up, so will this escrow requirement. So you're actually, if you escrow your insurance and your property tax, then your monthly payment will end up going up on your house. It's not that the mortgage is going up. It's just that the money that needs to go into the escrow account is increasing because your property tax is increasing, and your insurance probably increases too, because if your house is worth more, then it needs to be insured for more. So it may seem like, you know, your house payment's going up. No, your house payment itself is the same. It's the money needed to go into the escrow account to ensure that your insurance and your property tax are covered is what's increasing. So that puts this video about the 15-minute mark, and so that is where I wanted to stop. I just wanted to briefly do this example talking about escrow, because there is one very similar to that in the end section questions, and also if you're in my class in the online homework for this. And so again, I always highly advise you go try the Your Turn problems 6.114. I have verified that the answer there is correct, and the final answer in the back of the book is what it should be. And so now that you've watched this video, please go read this section in the textbook. There's a lot of stuff that I did not cover in this video, mainly because it's the same math, it's the same information, but it's specific to mortgages, which they cover in detail, and they talk about the benefits and the positives between renting versus home ownership, and there are some pluses and minuses, depending on which one you do. So make sure you read this section, take some notes. Once you're done and you have tried all the Your Turn problems in the textbook, head on over to the LMS and try the online homework to reinforce your learning for this unit.